U.S. oil production falling this year, according to the nation's biggest and fastest growing oil company. EOG Resources slashing spending by 40%, reducing drilling by almost half, and will maintain output at 2014 levels. This is from a company that has been growing their output at 50% a year since 2009. EOG says if they're cutting back, so will the rest of the industry. But that forecast contradicts figures from the U.S. Energy Information Administration, who say production is going to grow at almost 8% this year. So who is right here on U.S. oil production? Well, hopefully to settle this is Bloomberg oil and gas reporter Brad Olsen from Houston. So where do we get these two divergent forecasts? Who's right here?
I think that'll depend on the shale companies and which of them follow the EOGs of the world and which of them continue to pump. And that's the great unknown question out there in the market right now. Will there be companies like EOG that are going to stop drilling and kind of put on the brakes? Or will there be a lot of companies that keep going and try to keep pumping and kind of survive by producing even at minimal margins?
Well, I mean, that's a great point, Brad. So EOG is a market leader. If they're going to essentially I would say cut production because they're not going to be increasing it, right, by the amount that they have in the past, wouldn't others have to follow suit?
That's the big thing. One of the things that's keeping the companies pumping, the ones that are continuing to grow production, is hedges. So they've locked in prices at a little bit higher rates from last year, and that allows them to keep going. But the companies like EOG that have not hedged a lot of their production are able to stop production and say, we're going to wait for the price to come back up. That's exactly what they're doing. They're saying there's no reason to pump with prices being this low and to take margins being this low. And so that's sort of the decision. The big question mark is what's going to happen with all the rest of the producers.
Right.
There's almost 8,000 companies that pump for oil in the United States, and 8,000 companies don't always work together and march in lockstep.
No, and they're not all in the same area either, right, Brad?
That's right. There's different kinds of mechanisms and techniques for doing drilling. Some of them drill horizontally, and some of them drill vertically, and in many different areas of the United States. And expecting them to all work together would be like imagining herding 8,000 cats. It's almost impossible, and it doesn't really compare very well to OPEC, which we know is only 12 countries.
Right.
So imagine it's difficult for OPEC to work together. Imagine how much harder it is for 8,000 U.S. producers to work together.
So, Brad, where do we really know this supply or oversupply comes from? Is it out of OPEC or is it out of the U.S.?
Well, in the beginning, it was out of the U.S. In the last few years, a whole lot of new production came from the United States because of the shale revolution. But there also was new production out of OPEC. For a long time, there was not production out of Iraq. It took many years for that to happen. And then, of course, we know that there was a civil war in Libya. So there was production that was offline there. And those things came online again as shale continued to grow. And so that's why you have this big glut that exists right now in the market.
Right. Brad, thank you so much. Bradley Olsen from Houston, our Bloomberg News reporter.